that's who we are. We're a portfolio lender. We have a staff that completely handles all loans and escrows coast to coast on any loan we do. And so that's a bit about First Western Federal. I'm, as Austin mentioned, the Senior Vice President of the bank and in charge of the non-recourse program here. And we specialize, again, as mentioned, in financing buy and hold rental properties for people using their non-recourse or their self-directed IRAs all around the country in every state. And as a bit of a disclaimer, First Western Federal and our employees are not accountants, we're not investment advisors, and we're not qualified to provide the advice on IRA rules, regs, or eligibility requirements. So I would ask you to consult your tax and investment advisors about some of the legalities and kind of the transactions you're doing to make sure that they are all within the rules. So First Western Federal is here to help finance properties. You're ready to buy some real estate. What are some of the reasons you might want to take some of those hard-earned dollars and put them into real estate? As you investors know, there's several reasons, and one of them is you can buy an asset that you can see, touch, and feel. Unlike a stock or a bond or mutual fund, you're buying an actual physical address, and you can see the asset, touch it, feel it, it's there. Market ups and downs, that house or building will still be there in the future for you. And it does offer real asset diversification. In addition to having liquidity and investments in the market, which is a good thing as well, it's also good to have some asset diversification into real estate, which does provide a hedge against other short-term assets rising and falling with markets. There's a lot of choices in today's markets. With the additional foreclosures that are going back on the market there in Florida and elsewhere, there's a lot of affordable prices and opportunities for buying, because not only at a lower price point buying in do you have a better rental rate of return, but there's opportunity for the upside capital appreciation of the property over time. So what is a non-recourse loan? You've heard about them. What are they? Well, in terms of a self-directed IRA, a non-recourse loan is simply a loan that a lender makes to the IRA secured by collateral, in this case the real estate, and the IRA is obligated to pay the loan back, but should there be a default on those loan payments, the lender has no recourse, hence the term non-recourse, against the IRA itself, any other assets in the IRA, or against the owner of the IRA. So the loan is secured strictly by the collateral, and should the loan fail to perform, the bank can foreclose and collect the collateral, but that's it. The beauty of these loans is that you, as the owner, the investor, you're not obligated on the loan, so the loan does not show up in your name anywhere on your credit bureau or because you're not the borrower. This is a loan to your IRA. So separating that out, it's good because then we don't look at your personal financial picture, we don't look at tax returns, personal financial statements, or typical, perhaps personal assets and liabilities that you might when you're qualifying. It's all about the property, the cash flow it will produce, and the quality of that asset. To give you a little idea about what the terms are on these kinds of loans, First Western Federal offers 25-year financing on residential properties coast to coast. Anything on 1 to 4 family residential, we're writing with rates, as you can see by the slide, as low as 4 1/4 on our 3/1 arm, to 4 7/8 on our 5/1 arm, to 5.5% on our 10/1 arm, meaning the rate is fixed for 3, 5, or 10 years. And then once a year after the fixed period, that rate will just adjust up or down or stay the same for the remainder of that 25-year term loan. Also, we offer a 20-year fixed at 6 1/4. So if you want to lock that rate in from inception, keep it the same for the whole length of the time. If you're going to own that property, perhaps maybe 15, 20 years, a fixed rate might be the best product for you. We also will finance 5 units plus, a 10-unit apartment, 15-unit apartment building, commercial properties, vacation rental properties, say at the beach. We'll finance all those as well at a 50% loan to value And the rates have a 1% premium over the rates I just quoted. They range from 5.5 to 5.25 on our adjustable program to 7.25 on our fixed rate program. So there's several options again available on commercial and multifamily residential properties. So how long does it take to get a non-recourse loan? Well, typically it takes about 2 days to give you a loan decision. So let's say you put a property under contract today, you wanted to get financing on it. You could go to our website, fill out our non-recourse loan application, and send it in to us with the items on the checklist. We'll have some things like copies of your IRA statement, copy of your purchase agreement, things like that. Sent to us, we'll give you a decision in a couple days. If it's yes, we'll collect an appraisal deposit at that time, process, and close in about 30 to 35 days total time. So it costs nothing to apply for the loan. Only if we like your deal, we'll collect an appraisal deposit, we'll process it, and close it at a title company or you within about 30, 35 days. So it doesn't take any longer to close a non-recourse loan, candidly, than it does a personal loan, and in many cases less time, because we're not having to dive into all the personal financial details that can sometimes take quite a while to close a regular loan. So what are the issues then to obtaining a non-recourse loan? Well, the first thing is the money piece. Do you have the funds? And we require 50% down in Florida, 40 to 50% down most other states for the kinds of loans we do. So the first thing is, A, need the down payment, closing costs as you would have in any market buying real estate. And the third thing in terms of the money piece is reserves. We want to see at least 15% of the loan amount still left liquid in the IRA after close to be there for repairs. Perhaps a tenant moves out, need a little fix-up in that unit. Loan payments go on, of course, even when there's no tenants. So we want to see 15% of loan amount left in there. In other words, if we made a $100,000 loan, we'd want to see at least $15,000 left in the IRA as that operating buffer. The other piece is debt service coverage. The tenant or the rental income is what's going to service the debt. And so we have a metric. Our debt service coverage needs to be at least 1.25 or greater, meaning that the net operating income is at least 125% of loan payments. Third thing, is the property a good one? Is it in good condition? Is it in a good neighborhood, low crime area, rent ready or nearly so? And does the transaction just make common sense? Does it make sense for the investor and the bank? If it passes those basically 4 items, then we typically have a loan. So let's take a look at the first one, debt service coverage. This is the one that really drives a loan payment. So what I'll do is say to you as the investor, you provide me a pro forma income and expense summary on a property you wish to purchase if it's never been a rental before. And by that, you'll provide me with the income, the expenses, and show me how that will produce positive cash flow. So I have a couple of examples here of real-life properties we've financed. This one had a purchase price of $100,000 and a loan of $60,000. The rent per month is $1,000 per month, so gross rental income for the year is $12,000. We use a 7% vacancy rate, so that equals about 1 month a year that the property would be open. We think that's a fair amount to use for at least some allowance for vacancy, so build that into your model. Also, there's taxes, insurance, maintenance. The next one here was a home within an HOA, homeowner association. And a similar situation, we had a purchase price of $184,000 with a 50% loan of $92,000 and a $1,300 a month rental income. So $1,300 for a month produced $15,600 income for the year. Subtracting out vacancy, taxes, insurance, maintenance, HOA fees of $1,500 a year produced a net operating income of $9,308. And $9,308 divided by the loan payments of $6,373 was 1.46 debt service coverage. Again, the 9308 is 146% of your loan payment. That's good. Last one here was a commercial building that we financed for a gentleman in his IRA. It cost $600,000 and he put $300,000 down. And it was on a $5,000 a month triple net lease. So that property produced $60,000 per year, building in a vacancy factor of 4,200 as an expense. Being a triple net lease, the tenant paid taxes, tenant pays insurance, tenant pays the bulk of maintenance, although there was a portion that the owner paid, so we allocated $3,600 a year there. And lastly, they used a management company to handle the property, so that $4,800 expense coming out of the expense side produced a net operating income for the year of $47,400. The debt service on a 15-year term at 5 7/8 rate was $30,000. So $47,000 income divided by $30,000 debt service is 1.57. So again, as long as the property produces positive income to at least that metric, that's the key. And if a property has never been a rental property before, and a lot of them that I see investors buying are foreclosures that investors can buy at a pretty good price, you don't have a rental history to go on. So what I ask is that you give me a pro forma anticipated income and expense summary for the property so that we can see how it's going to perform. We will check your work when we actually have an appraisal done, because the appraiser will compare other rental properties in that neighborhood and come up with a market rent that that property can produce. So there will be a third set of eyes that look at your rental income and expenses and make sure that they're in line with the market. And just so you know, we will use the appraiser's market rent versus your rent if there's any difference there, because they're an outside third party. Some other things to look for then when you're buying property, and I know you investors out there, you're not new to this, but I thought I'd just put some reminders in there on some of the things that we look for, and maybe they're helpful to you. On homeowner associations, we want to make sure that the homeowner association itself is healthy financially. So we're going to require that you provide us with 2 years year-end financial statements. That's a balance sheet and an income statement for the HOA itself. So for right now, we're getting, for example, year-end 2013 and 2014 balance sheet income statements and a current year budget. We want to make sure that that HOA is solvent and is a good entity you're buying into, not just a good property within it. Crime, do your research. There's quite a few websites now online where you can put your address of a given property in, and there will be crime reports with actual crime detail of reported crimes in that neighborhood. So compare those and make sure that you're buying in a neighborhood that has a low crime. As you know, crime affects property values, it affects the quality of tenants, it affects resale, so it has a big impact on a property. Condition, property ought to be rent ready or nearly so. It doesn't have to be perfect, but it should be no more than $10,000 worth of improvements to make it rent ready. And by that I mean maybe it needs carpet, paint, and some appliances. Sometimes when people move out, they'll leave some deferred maintenance. As long as that deferred maintenance does not exceed $10,000, we can close a loan. We don't finance those repair costs. The self-directed IRA needs to be able to handle that after closing, and all we ask is that those repairs are done within 60 days after close, and we get copies of the receipt so that we know it's all been tidied up and ready to go. And then when we get a copy of a lease within 90 days of close. So we can work with you investors in buying properties that aren't perfect. We give you a little bit of time to get the property tidied up and leased up. And that's all part of our loan program and built in. We know it takes those kinds of leeways within properties to get them ready to go and performing. And lastly, we like to finance properties built current since 1940 or newer. And so we have a 75-year-old age parameter on a given property. Now, what can derail a loan? There are some things that could make a loan declined or not attractive to us as a lender. And what they are could be this. And let's say you apply for the loan and you anticipate getting $1,500 a month rental income, and you build your model on that, and so do we, but when we have the property appraised, it only can support a $1,200 a month rental income rate. We have to use the $1,200 per month that the appraiser can comp surrounding rental properties with. So that can be an issue. If you plan on getting, $12,000 a year in income and the appraiser says 10, we have to use the appraiser's numbers. So mainly, don't overestimate your rental income. And especially if you're buying a vacation property, do your research. Talk to vacation property management companies and other realtors who may handle them so that you're getting good, accurate data. Another one that can derail a loan would be buying the most expensive property in the neighborhood, or maybe you buy one that's been all fixed up. It's just beautiful. It's maybe several hundred square feet larger than the average home in the neighborhood, and the other surrounding homes are still peppered with some foreclosures and less quality properties. If we're being asked to finance $100,000 on a property, and the average sale price of properties in the area are $70,000 to $80,000, it's not going to work. So just understand, buying the least expensive property in the neighborhood is oftentimes far more advantageous than buying the most. High crime areas, as I mentioned before, we're going to pull crime reports for any given area, and if the crime is too high, we'll not lend in that area. Poor condition of the property. Let's say there's foundation issues or plumbing issues, it needs a roof, electricity problems. Issues like that are going to require $15,000, $20,000, $30,000 or more to cure is going to make the property unattractive to the bank to finance. Now, that's not to say it may not be a good investment for you, the investor, but it's not a property that we'll finance. But I will toss this one idea out. We can do purchase money or refinances, either one. And there are times when an investor will find a good property, needs work. They'll go ahead and buy it for cash, do all the repair to it with cash as well out of the self-directed IRA, and then now it's ready to go and rent ready. We can do a loan on a property now that's rent ready, that's been rehabbed, and we'll basically lend our money based on the cost of the property and the rehab dollars spent. I need to take into account all of your IRA loans to other non-recourse lenders or our company or even private lenders, and make sure that your total debt service that the IRA has to pay each month, each year, does not exceed that 1.25 global. So keep that in mind, that if you now have 2, 3, 4 other non-recourse loans out there, we're going to take those into account when we're looking at your current request, and the whole entity does need to have debt service at least that 1.25 level or better. Lastly, reserves. That could be a problem if you have multiple IRA loans again, because we will require 15% of any and all IRA non-recourse loan balances. Again, just because you may not have a loan with us doesn't mean you have a loan you still have a loan to support with a lender over there. We don't want to see a borrower getting into trouble in not paying loan obligations because they don't have enough liquidity. So that liquidity in the IRA is a very important factor for the bank in looking at, because the operating funds need to be there for a variety of things. The last thing we want to see is someone lose a property just because they don't have enough funds in their IRA. What kinds of entities can we lend to? Well, we can lend to any self-directed IRA or LLCs made up of single or multi-member self-directed IRAs or self-directed 401ks or LLCs made up of those kinds of entities. So we can lend to basically any self-directed IRA or plan that meets those kinds of requirements. And what will we lend on? Well, we'll lend on pretty much any kind of residential property, whether that's a 1 to 4 family residential or 5 units plus, might be a 10-plex, a 15-unit apartment building. We also lend on commercial properties. There may be a strip center or a office warehouse, even farms with income. There are investors out there who know ag very well and may buy a piece of farm ground and lease it out to the nearby farmer, and all that income comes into the IRA and expenses go out, and we can lend on farms as well. So that's the kinds of things we do, and we're nationwide. We lend in all 50 states. So even though you may not have a property in your own town where you are living that appeals to you as an investor, maybe there's something across the country in an area that you know well, or you have experience from vacationing there and you know the market. We lend in all 50 states. Austin, do you have any questions that anyone from the audience or you may have that I may be able to answer here that might help?
Yes, Roger, I actually do have a few questions for you as we've been going through this. One, you kind of answered halfway through for me there, but you said something about I can refinance an existing rental property. So essentially what you're saying is that if I have a rental property inside my NewView IRA, I can refinance that in order to pull some liquidity for other investments? Is that what you?
Yeah, that's right. Let's say that you bought a property, paid $100,000 for it, bought it with cash, and didn't anticipate taking a loan out, and that's fine. It's working well. But now you're looking to expand your investments in more real estate, and you're thinking, gosh, if I had some leverage, if I could pull some money out of that property I already own, I could use that as a down payment on my next purchase. Well, we can do that. If you own a property free and clear, I can lend up to 50%, or in most states 60% of what you paid for that property. So I can set up a nice 25-year long-term loan on it and put that loan proceed back into your account so you can use that for another purchase.
Gotcha. So can I leverage more than one property on a non-recourse loan?
Yeah, you could. And let's say you owned 2 different properties free and clear, and you wanted to buy a third one, and the value is enough that you could take let's say you had 2 $100,000 properties in your IRA. I could lend 50% of that $200,000 total. Now I can loan $100,000 back to the investor, and the investor can put that money in their IRA. Or maybe in lieu of a down payment on the next one, we take one of the homes that you already own, plus take the new one, and just lend on both of those as one loan. And oftentimes it can save on closing costs. It can save on some other fees because you're using one loan, not 2. And again, we can lend up to your cost of purchase plus your rehab costs. So maybe, like that example I used before, let's say a house costs $100,000 to buy, put 20 into it to get it fixed up. Now you have 120 into it. We'll lend to you based on the 120 you have invested in that property. So purchase money or refi, we'll do either one. Yep.
Gotcha. So I have a scenario question for you here. Let's say me and my spouse, we both have NewView IRA accounts. Can we partner together to buy a property and use a non-recourse loan to borrow a portion of the purchase price?
Yes, and I see that quite a bit, where maybe one investor doesn't have all the money that they would require, or just they want to diversify a bit and don't want to own that property completely. And oftentimes there's husband and wives or 2 investors that have the same administrator custodian want to go in on a property together. So it's not unlike, if you think about a husband and wife on a home mortgage, you could even have your husband and wife's IRAs with New View put the down payment in, and then I lend to the two borrowers from New View. So it would look like, as a borrower, New View IRA FBO Bob Smith and New View IRA FBO Sally Smith as the borrowers. So yes, you can put two borrowers together. There'll be co-borrowers on the loan, and each IRA just makes half the payment that's due, or whatever percentage of ownership you have. So I see that quite a bit, where there's more than one borrower. It doesn't pose a problem for the bank. It's just another way that you can make your money go farther purchasing real estate, is to partner up. Yep.
Okay. So if I buy a property for cash and fix it up so it can be rented, how much money can I borrow against it?
So I will lend up to, now in Florida we're a 50% lender. A lot of other states we lend 60%. So I will lend in Florida 50% of your total cost in. So that would be the cost of acquisition plus the rehab cost. So again, an example, a $100,000 purchase price plus $20,000 in rehab. I'm going to lend based on the $120,000 total cost invested. Yep.
Okay. Well, that's actually all the questions I had for you. If anyone else that's listening to this in the future has any questions, Roger, what's a good way for them to get in contact with you? Would it just be going to the website, or?
Both. If you look at the slide I have up now, we have an 800 number that you can call anytime. 8 to 5 business hours here. We'll answer, or we'll take a message, and it's 800-908-8845. Or you can contact us at our website, which is www.myiralender.com, or you could just email, and that's roger@myiralender.com. So either way, if you have a question, don't hesitate to call or email, and I'll be happy to answer any question or take care of any loan request you've got.
Great. Well, Roger, I greatly appreciate your time today, and I get this question maybe 2 or 3 times a day from clients, so I'm glad that now they'll finally have a resource at their fingertips.
I'm glad to be able to have the opportunity, Austin.